A few years ago, you and your spouse made a decision. Maybe the kids were finally both in school. Maybe a promotion bumped one of you up a tier. Maybe a second job opened up across town. Or your partner went back to work after a long stretch at home. Whatever the trigger, you sat down at the kitchen table and ran the numbers, and they looked good. 2 incomes instead of 1. The math on paper was beautiful. You'd pay down the credit cards by spring. You'd start that emergency fund you'd been talking about for years. Maybe even take a real vacation, the kind where you don't refresh your bank account every morning. That was the plan. Now it's a few years later. Your household earns nearly twice what it used to. And somehow, the credit card balance looks the same. The emergency fund is whatever happened to be sitting and checking last Tuesday. The vacation got postponed again. You're working more, your spouse is working more, the kids see both of you less, and the savings account is barely registering any of it. You're not crazy. You're not bad with money. The math you ran at the kitchen table wasn't wrong. It was just incomplete. There are 5 layers sitting between your second paycheck's gross number and what it actually adds to your household savings. 5 quiet subtractions that nobody puts on the same page. Each one looks reasonable on its own. It's the stack that does the damage. And by the time we're done today, you're going to know exactly how much of that second income is real, how much of it is bookkeeping, and where the missing dollars went. Rule 1 of personal finance. The math is almost always simpler than the people selling it want you to believe. The 5 layers we're about to walk through are not hidden because anyone is hiding them. They're hidden because nobody adds them up together. Let's meet our reference household. Married couple, both 38, filing jointly. Earner A grosses $60,000 a year. Earner B grosses $60,000 a year. 2 children, ages 3 and 7. They live in a mid-cost American metro, somewhere like Columbus, Raleigh, or Salt Lake City. Both jobs are W-2 salaried full-time. They have a standard mortgage on a home they bought after Earner B started working. Deliberately ordinary. This same household carries us through all 5 layers, so when the running figure changes, you'll feel it. $120,000 gross. That's where we start. Now watch what happens to the second $60,000 of it. Layer 1. The tax bracket climb. Here's where most people's intuition breaks first. There is a difference between your average tax rate and your marginal tax rate, and that difference is the whole game. Your average rate is what you pay across all your earnings combined. Your marginal rate is what you pay on the next dollar you earn. The second paycheck, by definition, is not made of average dollars. It is made entirely of marginal dollars. It walks into the household at the top of the bracket stack. In our reference household, Earner A's $60,000 fits comfortably inside the lower brackets. Married filing jointly, the first roughly $23,000 of taxable income falls in the 10% bracket, and the next chunk runs through the 12% bracket. Federal tax on Earner A's income alone is modest. Now, Earner B walks in. Earner B's first dollar is the household's 60th dollar. Most of Earner B's income lands squarely inside the 22% federal bracket. Add FICA, Social Security, and Medicare, 7.65%, comes out regardless of bracket. Add a representative state income tax, call it 5%. Add the loss of certain income-tested credits as household income climbs. Crunch all of it together, and Earner B's gross $60,000 loses somewhere between $11,000 and $13,000 to combined taxes. We'll use $12,000 as our reference figure. The IRS named this section of the tax code 401k for the most thrilling reason imaginable. It's literally subsection 401, paragraph K. That's the whole naming story. The brackets, by contrast, are even less poetic. They're just stacked. Running net figure, $48,000. We already lost 20% of the gross before getting near a single household expense. We've just paid for permission to keep the rest. And the rest is where it gets interesting. Layer 2. Childcare. The largest single subtraction for households with young children, and the data has gotten worse, not better, over the last decade. The U.S. Department of Labor maintains the national database of childcare prices. The Bureau of Labor Statistics tracks family childcare spending in the Consumer Expenditure Survey. Both point at the same uncomfortable reality. Center-based full-day care for a 3-year-old in a mid-cost metro now runs somewhere between $14,000 and $18,000 a year. Before and after-school care, plus summer programming for a 7-year-old runs another $8,000 to $10,000. 2 children, our age range, our metro, $24,000 to $28,000 annually. Use $26,000 as our reference. That number comes off the second paycheck. Not part of it, the whole thing. Earner B is, in a real arithmetic sense, working full-time so that someone else can watch the kids while Earner B works full-time. This layer flexes a lot. Households with grandparents who watch the kids compress this number dramatically. Lower-cost rural areas pay less. Households where one parent works school hours can collapse this layer almost completely. Running net figure, $48,000 minus $26,000 equals $22,000. We started with a $60,000 paycheck. We're down to $22,000. We have not bought groceries. We have not put gas in a car. We have not paid the mortgage. We've just paid taxes and the people who watch our kids while we earn the rest. Layer 3, the second vehicle and the commute stack. When both adults work outside the home, on different schedules, going to different places, a second vehicle stops being a luxury and starts being infrastructure. AAA publishes an annual report called Your Driving Costs. They track the all-in cost of owning a typical mid-size sedan: depreciation, insurance, fuel, maintenance, financing, registration. The current number is approximately $12,000 per year for normal annual mileage. That's not the cost of a trip. That's the cost of having the second car sitting in the driveway, ready for Earner B to use. If Earner B's job vanished tomorrow and the car got sold the same day, that's $12,000 a year that goes back into the household. Households that bypass this layer exist. Dense urban with good transit. One remote worker plus one in-office worker can sometimes share a vehicle. These households are real and they should not be ignored. But they are not the median dual-earner household with 2 kids in our reference metro. The median household needs 2 cars, and the second one costs about $12,000 a year. Running net figure, $22,000 minus $12,000 equals $10,000. Under $10,000 left from a $60,000 gross. And the next layer is the deepest one. Layer 4, housing inflation. This is the layer that hides in plain sight. Mortgage qualification is calculated on combined household income. A bank looking at our reference household sees $120,000 in qualifying income, not $60,000. The mortgage they will write for that household is meaningfully larger than the mortgage they would write for a single earner, $60,000 household. This isn't a criticism, it's an arithmetic observation about how the lending system works. The Federal Reserve Bank of New York's quarterly report on household debt and credit tracks origination patterns. Census Bureau American Community Survey data breaks down housing cost burden by household structure. Both data sources show the same pattern. Dual-income households systematically purchase more expensive housing than the income-matched single-earner equivalent. The second paycheck doesn't sit in a savings account. It is, in part, absorbed by a larger mortgage, larger property tax, and larger maintenance load on a larger home. For our reference household, the additional annual housing cost attributable to qualifying for a bigger mortgage on 2 incomes, extra principal and interest, extra property tax, extra maintenance scaled to a bigger home, runs approximately $6,000 a year. The framing here matters. Nobody made a mistake. Nobody bought too much house. The system rewards 2-income households with access to larger homes, and a chunk of the second paycheck quietly funds that access. Structural, not personal. The Big Short made a whole movie about how mortgage math doesn't work the way people think. This is the small, quiet, perfectly legal version. The system optimizes for the size of loan it can write, not the size of the savings account it leaves you with. Running net figure, $10,000 minus $6,000 equals $4,000. Layer 5, lost domestic production. the most contested layer and the most underappreciated. When both adults work full-time outside the home, a meaningful amount of work that previously happened inside the home either gets outsourced or doesn't happen. Meal preparation, laundry, cleaning, household repairs, shopping. The logistics of running a household are genuine labor, and economists have a name for the value of that labor. They call it imputed household production, and the Bureau of Economic Analysis maintains a satellite account that estimates its dollar value. The BLS, American Time Use Survey, and the Consumer Expenditure Survey track how spending on food, away from home, prepared meals, and household services climbs as employment hours climb. The pattern is consistent. A transition from one earner to two earner increases food away from home spending, prepared food purchases, cleaning services, and convenience spending by somewhere between $5,000 and $8,000 annually. Use 5,000. Pick the low end on purpose, because we're not in the business of inflating our own thesis. Running net figure, 4,000 minus 5,000 equals negative $1,000. Stop and breathe. We started with a $60,000 second paycheck. We subtracted $12,000 in marginal taxes, $26,000 in childcare, $12,000 in vehicle costs, $6,000 in housing inflation, and $5,000 in lost domestic production. The residual is negative $1,000. On gross numbers, the second paycheck doubled the household income. On net numbers, it added nothing. And depending on the household, it may quietly subtract. That is the whole math. It took us 5 layers to get there because each layer alone seems manageable. It's the stack that does the damage. Now, and this part is non-negotiable because nobody honest does this without saying it out loud, let me name the limits. The 5-layer math is short-run math. It is the annual marginal contribution of the second paycheck. It is not the long-run value of the second earner's career, and the long-run value is real and often substantial. The second earner's career compounds. Employer retirement matching is free money the household cannot access without the second job. Employer-sponsored health insurance can be worth $15,000 to $20,000 a year on its own. Social Security earnings credits accrue independently. Promotions stack. If the primary earner loses their job, gets sick, or becomes disabled, a household with 2 active careers is structurally more resilient than a household with 1. The optionality value of a working spouse, the simple fact that you have a backup, is enormous and almost impossible to put a clean number on. The 5-layer math is one true thing. The career capital math is a different true thing. Both matter. Neither cancels the other. Households also vary wildly. A household without young children erases most of layer 2, $20,000 to $26,000 back on the table. A single vehicle household in a dense transit metro compresses or eliminates layer 3. A household that consciously buys less house than the bank will lend them eliminates layer 4. Grandparent-provided childcare or a parent who works school hours compresses layer 2. Each of these moves the residual by thousands or tens of thousands of dollars. Our reference household sits at one specific point in a wide distribution. The residual figure for your household is your residual. We're not predicting it. We're handing you the framework. So here's that framework. Fast. Take your second earner's annual gross. Subtract their effective marginal tax rate. 25% is a fair default for dual-income middle-bracket households once you fold in FICA and state. Subtract your actual annual childcare spend. Subtract $12,000 for a second vehicle if you own one. Subtract 3% of your home's purchase price as a housing inflation premium attributable to dual-income mortgage qualification, only if you bought after the second income started. Subtract $5,000 for lost domestic production. The number you have left is your second paycheck's real annual contribution to household savings. Some of you will run this and find a healthy, positive number. Genuinely good news, and it means your specific structure compresses some layers we couldn't compress in the reference. Some of you will find a number close to 0, or a slightly negative one. That is not a sign of failure. It is the math doing what math does. It tells you something useful about where your second paycheck is actually going. Notice what we did not do today. We did not tell you to quit your job. We did not tell you one earner should stay home. Those are personal decisions that depend on careers, kids, communities, health, and 100 other things that don't show up on a pay stub. What we did is replace a feeling with a number. The reason this math matters is not that it changes the decision. It's that it changes how you plan around the decision. If you're budgeting, projecting retirement, deciding whether to buy a house, deciding whether to take on a car loan, and you're doing those calculations against the gross of two incomes, you're using the wrong number. The right number is the residual. Plan with the residual, not the gross. Everything downstream gets calmer the moment you do. The second paycheck is not a trap. It's just much smaller than the printed number suggests. The trap is the gap between what it looks like and what it actually adds. And you just close that gap. The best financial decision is the one you understand. Now go make yours.